So, you've spotted a stock or ETF that you believe is going to go up over the next year, and you're not one to back away from risk. You have a few choices. You could, of course, shell out the full price of the stock. Another route is using margin, borrowing against your assets to make the purchase. But that brings extra costs and added risk. Alternatively, you can consider LEAPS call options, which are a less capital-heavy way to use leverage. LEAPS, or long-term equity anticipation securities, are simply options with more than 270 days left before they expire. We're focusing on calls here, which give buyers the right to purchase the underlying stock at a specific price by a certain date, but with a longer time horizon. LEAPS calls offer an alternative to buying shares, since they tend to rise in value as the stock price goes up, all at a fraction of the stock's full cost. This chart is a great illustration of why some traders go for LEAPS options. The value of this call jumped by 117%, compared to a roughly 46% rise in the stock. However, you'll notice the option was far more volatile, highlighting that leverage trading isn't for everyone. That kind of upside with less upfront capital is why some traders consider LEAPS a strategic substitute for buying the stock. We'll walk through why that is, weigh the pros and cons, compare them to margin trading, and offer a few things to consider. If you're just starting out with options, you might want to watch some of our beginner-level videos. Let's dive in. First, the basics of LEAPS calls. As mentioned earlier, LEAPS calls function just like standard calls. In general, when the stock rises, so does the call's value, and if it drops, the value of the call goes down too. Calls can expire worthless as well, which means you might lose your entire investment. That's why the risk profile is the same as a regular call. Theoretically, they offer unlimited upside potential, since they can climb as much as the stock does, right up until expiration. The risk is defined too. You can't lose more than what you paid for the option, as long as you exit before expiration. You might go for a short-term call to play a quick price swing. But if you're aiming for a longer move, LEAPS could make more sense. But there are a few drawbacks when using LEAPS as a substitute for owning stock. Call holders don't get dividends, don't have voting rights, and can't use LEAPS for loans or margin. Also, the option premium will decay with time and can eventually become worthless. The leverage also makes them volatile. So while you can see big gains, you're just as exposed to losses. LEAPS may seem simple, but like any long option play, they carry some complexity. You not only need to get the direction right, but also the timing, though you get more time than with short-term options. Plus, because LEAPS are sensitive to implied volatility shifts, you'll want to monitor that too. You could be spot on about the direction, but still lose money if you miss on other key factors. Let's go over a few more points to keep in mind if you're thinking about getting into LEAPS. You'll still need to do your standard stock research before buying a LEAPS contract. That includes your usual mix of technical and fundamental analysis, looking at future earnings potential, financials, price trends, etc. Also, factor in the outlook for interest rates. Rho helps you understand how the contract responds to interest rate changes. LEAPS calls tend to be Rho positive, so higher rates might boost their value, while falling rates might drag it down. Once you've done your homework, you can pick a contract. One benefit over margin trading is you get to control how much leverage you want. based on the contract you choose, its expiration, and how in or out of the money it is. When selecting strike prices and expirations, you'll want to consider a couple of things. First, LEAPS expirations can run up to 3 years. The longer the duration, the more expensive the contract, reducing your leverage. All options lose value over time, but the time decay slows down. With longer dated options, choosing an expiration beyond your expected holding period can help buffer against time decay. Second, deep in the money options cost more but offer less leverage. On the plus side, they track the stock more closely. Many traders aim for calls with delta values between 0.60 and 0.80. When selecting strike prices and expirations, you'll want to consider a couple of things. First, LEAPS expirations can run up to 3 years. The longer the duration, the more expensive the contract, reducing your leverage. All options lose value over time, but the time decay slows down. With longer dated options, choosing an expiration beyond your expected holding period can help buffer against time decay. Second, deep in the money options cost more but offer less leverage. On the plus side, they track the stock more closely. Many traders aim for calls with delta values between 0.60 and 0.80. Call moved with the stock. And because this chart shows percentage return, the smaller initial investment gave a significantly higher return. Closing this position would likely have meant profit. Now compare that to another LEAPS trade. That didn't do as well. It also had 745 days to expiry and a 0.70 delta. It was choppy at first, but as the stock declined nearly 15% over the year, this call fell by around 57%. Using LEAPS instead of stocks can for more aggressive investors looking to boost returns.